From one retail investor to another, this is Trader72. Welcome back, guys, to my show. I hope you are all well. It is an absolute scorcher today in the UK. I think the rest of Europe is also in a deep heat wave. But it is hot, but I have a lovely aircon here and I'm cool as a cucumber. But anyway, never mind all this. I'm back after a little layoff since last week. Busy old schedule. Today, we're going to be breaking down Spotify. Yes, some of you may just think that it's just an app, a music app, but it is a lot more than that. It's almost a global platform now these days. Network effects, potential huge effects, upside even. But the big question is, of course, that we like to see and straight away and have a great kind of input on it is my famous DCF model. Are we overpaying for a stock of quality? That is the question today on the question. So we're going to go straight into that at some stage. We've got to get a little bit more like I normally do with my format, a meaning, a moat, and a management, obviously, and obviously just a little bit more of the numbers, delve into that, and then give you my final thoughts on whether or not it's worth an investment, and also, of course, whether or not the stock is cheap based on my intrinsic price, which you guys by now I'm sure are well aware. Some of you may not know the intrinsic price is the true worth price based on a free cash flow model 10 years back and 10 years on. So let's go without any further ado. Let's start with our actual Spotify business model and how it was founded. Spotify was started basically by two people, Daniel Heck and Martin Lorenston, as you can see, back in 2006. Let's go back a little bit in time here. It launched its product in 2008, fought music piracy for many years. I remember using it myself quite early on when I was at my first company, listening to all sorts of different music. It was actually quite an interesting model at the time, but obviously it did fight quite a few legal battles, streaming alternative, etc. But it was first of its streaming services. It then listed in 2018 on the NYSE as SPOT ticker, and changed the market from buying albums to actually streaming. I think that's the main port of call for this company. It has obviously in the last 6 years pivoted towards an audio pivot, broad podcast studios and audiobooks, which I will go into in a minute. So what is actually Spotify? Spotify is basically the middleman between the actual record companies and the listener. It literally is a utility network. It sits between people who create music, obviously independent artists, podcasters, and the people who consume it. They don't actually own the music. I think this is really important to understand that they actually rent for the rights. So effectively, it is record label, independent artists, podcasters, via the middleman Spotify that spits it on the other side to mobile phone, desktops, and millions of listeners. So, breaking down the revenue model, it is basically effectively a premium subscriber, which you pay a subscription, like a lot of companies do, like Adobe and so forth. So it is a regular income, and that's 87% of the revenue. So user pay a recurring monthly fee, highly predictable, recurring, sticky revenue, which we like as a business for sure before you invest. Then obviously, so that's it. And then you've got the ad-supported users, which is the rest of it, which is 13%, which is for free to listen to it, but with ads. It is not as high, obviously, revenue stream, but it is still 13% of the revenue. So that kind of serves, that's the two main models of Spotify. So obviously it has evolved recently. So just to go back in terms of what they make, for every pound they make, they obviously have to pay quite a high rent on those music. So they've had to come up with alternatives as well to increase their business model. But that kind of breaks down pretty much the basic idea of Spotify as basically the middle utility network really between the record industry and the people that listen to it, which is I feel quite a clever model in that respect. To break out actually of the trap effectively of just having those those recurring premiums, and also to get away from the actual model of renting out the music for people to listen, which is quite costly. They've they've pivoted, let's say, to total audio platforms, they call it, heavily invested in podcasts, audiobooks, and ad tech networks, which has increased the revenue from there. So it's a much larger cut of the profit. So for every pound they make, pretty much they pay 70 pence on the pound, or 70 cent on the dollar if you're in the US. I know a lot of you are from the US listening to me, which is great, so welcome to my show again. And effectively it's quite an expensive way to run a business, so they've had to, like I said, pivot to more audiobooks and podcasts, which we know at the moment is super successful as we stand on social media. So let's break down the revenue for Spotify, guys. So premium subscription revenue is at 18.3 billion. So it's 90% of the revenue really from income stream. Then you've got the ad supported revenue, which is 2.1, which again is up year on year, 15%. And other revenue streams that come in, which is pretty minimal there. It has over 800 million user active users, which is up 6% year on year, and it has a premium subscription of 310 million people, and it's a year on year 7% up, which is quite substantial. So a subscription of 310 million is always a good thing in terms of bulk, and I'm hoping that obviously they will increase that in time. So gross profit is around 31%, which is a decent margin, really, if you ask me. I think that's up there with some of the tech companies. So that's a big tick there from that point of view. Operating income is also up 12.6%. They have got quite a bit of expense. I mean, obviously the cost of revenue at 12.2 billion. That's up 5%. So there's quite not a lot, nevertheless, of outgoings in terms of music industry payouts and royalties, which obviously they have to pay for every time they actually pay the privilege of playing the music on record, for the record companies. It has quite a large amount of sales and marketing, R&D as well there, etc. But really, all in all, it's pretty decent margins in terms of revenue for the company. So Let's delve a little bit more in the numbers, guys, because I like to kind of get very quick comparison. Now, I like this format because it actually helps me for you guys and for me to understand quite clearly where you should be looking at when you're looking at a P&L or, the numbers of a company, the revenue stream. So it's important to understand, obviously, what the market cap, that's the first thing I look at, because that is what the company is worth if you were to buy it tomorrow. So it's currently worth about $26 billion. That's obviously up to date for 26. Obviously, it's moves constantly. And then the next thing I look at is enterprise value, which gives you the actual difference between market cap and enterprise value, which is obviously the debt. So as you will see, there's about $5 billion in debt at the moment. That's obviously counting everything they owe. So there is a certain debt, but considering that the next thing you must look at really is the free cash flow. Now, the free cash flow is obviously very important. Let me just show you guys, just for you guys who might not know what free cash flow is. I know most of you will, but it is catered as well at people that are entering the industry as it is when you're investing. These are very important things that I've had to learn very quickly. Now, obviously something to look at. So the free cash flow, the reason why the free cash flow is important, as it says there highlighted, investors love free cash flow because unlike net income, which obviously a lot of people look at as prime number of what a company makes, it can be, the accounting profit can easily be faked or manipulated by the internal accounts department within that company or externally to kind of make sure that the company looks good on paper. So the free cash flow, you cannot fake that because it's actually the actual money left over after all operations. So a company can only look highly profitable on paper, but if all their money is tied up in unpaid invoices or unsold inventory, they might actually be below the real cash flow. So what does a company do with cash flow? It pays dividends, buys back stocks, which if the stock is cheap or it's at a 52-week low. It pays off debt, obviously, and also helps with acquisition. So it is the lifeblood of the company. So this is just a quick snapshot, a snapshot of, or for people to be reminded of it as well, of the free cash flow and how important that free cash flow is in terms of paying the debt. So that actually brings me to free cash flow, what they're making. So they're up on the free cash flow, which is very important. That means that they can probably pay back their debt within 2 to 3 years, which I think is quite important. Because obviously if a company is highly leveraged, then I tend to look elsewhere. Because if anything goes wrong, obviously, then it will be a struggle to pay back that debt. So it looks like just from the free cash flow alone, they will probably get out pretty much into 2 to 3 years, which is what I like to look at as a criteria. Let's have a quick look at the compounding revenue. It's kind of steady-ish, 18%, 10 years, 16, 17. So it has had a bit of a wobble up and down. But the gross profit margin is, for me, very impressive at 31%. That is really a good gross margin there. On the 10-year profit margin, also very good to see that it's going up from 10 years to 5 years, from 9 to 12.5%, 12.44%. And that is obviously on the up. And as you can see there, the net income is at 2.56. Now, I like to see the free cash flow being above the net income, as I explained why. So that's something maybe a bit of a question mark there. But on average, the net income is on the up from the last 5 years, from 1.67 billion to 2.56. Now, the P ratio. Now, for some of you who, again, I can explain that one very quickly. The P ratio is currently at 34. It was at a whopping 72. So just to give you a quick explanation here, again highlighted. So as an example here, 31 means investors are paying $31 for every $1 of profit Spotify makes. While that might be a high compared to standard blue chip company, which is around the 21 to 22. It's actually quite reasonable for a major tech streaming platform with strong projected growth. For comparison, it is currently trading at a lower multiple than companies like Apple at 36 times earnings. So that to give you an example that a lot of investors look at the P ratio. For me, there's a mixture of different matrix that you can look at. P ratio used to be one of the main ones, but now I'm looking at various different other matrix, such as the DCF model that I go on about, and the obviously intrinsic price and the margin of safety, and that gives you a really true worth price of the share price. But for me, the P ratio kind of combines with PEG as well, which we can see here actually. At the PEG, which is under 1, which normally tends to mean that it is quite cheap, the share price. But let's see that to compare that with the P ratio and obviously the DCF. So that will all be confirmed. So that gives you again an idea of the numbers, guys, what we're looking for. But all in all, the numbers look pretty decent and are certainly on the up, maybe bar the revenue growth, the compound revenue growth, but everything else looks pretty decent in terms of numbers. So as you know, guys, I like a bull versus bear case. So in terms of the bear side, obviously pricing power, ecosystems locked in, and the margin turnaround is officially real. So basically pricing power, Spotify's raised subscription recently, launched new tiers, audiobook access plan, and churn didn't spike, providing this app as a daily utility, not a luxury, which is actually quite important. The margin trap is broken when they pivoted towards podcasts and video podcasts and live entertainment partnership, like new concert ticketing features, Live Nation, which they did a partnership with, and they are capturing much higher gross margin, which already was quite decent. So the net profit is surging. Apparently, I mean, when looking at the numbers again, we need to just make sure that 200%. Undisputed king of scale. They're just not winning. They're the streaming wars in terms of music. I think they're the number one place to go to with over 700 million views. I think that at the moment they're pretty much as successful, even more successful than the Apple, which obviously has a similar system, outfit. It's incredibly hard for users to switch to Apple or YouTube and recreate years of personalized playlists. Now, I'm sure you guys are well aware that you all have a playlist that you build over years and years, and it's very hard to obviously interchange. A bit like having a bank account with a certain bank. I did Spotify recently, and it's very hard to do to switch everything across when you're with somebody for that long, or you've built really your playlist as it stands there. So that is quite hard. So that's actually a big plus, I think, for Spotify in that respect. Now, the bear case. It is at 31, so already priced in and an insane amount of flawless execution. The stock is trading near 452 at the moment. So, obviously the DCF model will come to that in a minute. So that's where we're looking at. I think the important part of the bear case is the fact that insiders have dumped a lot of their shares. Now, that's never a good thing when you see people dumping their shares. Executives have dumped nearly $60 million worth of stock in the past few months. Insider buying is sitting at flat zero. So that is a concern that I would definitely be flagging up, and you guys should look further into it. If manager thinks the stock is great deal here, why are they selling? And that, I think, is a very good question there. So that definitely is a good point. I think the P ratio, yes, it is at 31, but it is cheaper than it was. It is a tech company, so the P ratio will always be quite high as a rebuff to the bear side. The rented content reality as the third part. So Spotify still doesn't own the music, which is obviously could be an issue in the long term. They are at the mercy of the big three record labels. Furthermore, competition from big tech giants with infinite cash, Apple, Google, Amazon, could eventually step into that market and obviously produce a roadmap to stay ahead. So I think that is potentially another point to look for, and there's always a yin and yang in every stock, so nothing's ever perfect. If it was, we'll all be millionaires, and that we ain't. Well, I certainly not, so maybe some of you are out there, but yes, so I think that would be something to look out for. So I think it's quite a compelling bear case there in terms of the dumping of the stock from insiders, and the fact that at some stage the behemoth of YouTube, Amazon, and Apple could spend the money, further money, to potentially encroach into that market. But again, as I said, there's a compelling bull case as well in terms of people not moving across and being happy with the service and having their playlist history having to be redone completely. So phenomenal business, massive scale, improving profit, but it doesn't leave a lot for error in terms of what the valuation is so far. But let's move on to the DCF model and see what the share price is worth. So the DCF model that I very much use as my main core of where the share price is on its own, without the once you've kind of worked out the story, then you've got to work out the number, where the stock price is at the moment. So I've decided to go at around 15% of the actual growth for Spotify as a joint, as a whole. Obviously, we're looking at the next 10 years. That's important. So we are looking at discount, my usual discount of 8%, which obviously the money devalues as time goes on. I thought you've got to factor that in, and perpetual growth, which is beyond the 10 years. Which obviously is average at GDP, US GDP, which is about 2.5 to 3%. Some people like it at 2%, 2.5%, but I think 3% is about right on average for the US GDP. Now, you could look obviously at further on. You could be looking at that Spotify is currently, you could say a little bit higher than that, a bit more aggressive. But I think 15% kind of sits nicely in the middle range, I think, of what it can achieve for sure. So that gives us pretty much a intrinsic price of $555. Currently the share price is at 468, although I think it's fluctuating right now about 452. So that does give us a margin of safety of 18.43%. Now, is that good? Now, it's undervalued at this moment based on that 15%. Obviously, if you were to lower that or up that, the intrinsic price would slightly change. But we are looking at a ballpark of anything between 550 to, on average, to 550 to maybe 575, maybe even 600 if you decide to go quite aggressive. I believe that that's kind of fairly much in the ballpark. So 18%, as you guys know, 18% is not enough for my criteria, which is a minimum of 25%, because I think it does give you a little bit more margin room if the stock price falls or is a falling knife, which means obviously falling knife, buying a stock at a certain price, it falls again and again and again. So I think from that point of view, 18% it might be a bit short, but it is currently undervalued. And if you guys have got a very different threshold, everybody's got different thresholds in terms of what they feel they want to buy in at, especially from the margin point of view. Some investors go as far up to 50%, some 30%. I'm around that 25%. I think 50% for big caps tends to be slightly overdone. But listen, I bought into Uber recently, which is at almost 45% discount. So I think if you're looking at Uber, which is a global company with more facets, 45% is pretty good, considering Spotify is in a slightly more smaller market, slightly more competitive. Perhaps 18% is a little bit short, but still, nevertheless, it's undervalued, which I think will surprise quite a few people, considering that obviously the P ratio is around 31. But as I said, it is a tech company, and you have to look at the actual sector of the company and where it's at. So my final thoughts on Spotify. Let's just recap very quickly. We have got a very compelling bull and bear case. I think the fundamentals are strong. So let's be clear. If Spotify can keep at 15% growth model, I think that will obviously at some stage increase the share price, because potentially the share price could go up above north of $600 to $700. That obviously is if they can keep their complete monopoly on their own market. So far, they've withstood the onslaught of Apple. The network mode is completely intact. Converted free users into pure recurring cash flow. That's a great side. I think that obviously in terms of the actual strategy itself, well, for me, it would go on my watch list at the moment. It is undervalued. I am putting Spotify on a high conviction watch, so that means a fairly important, that would be in my top tier of watch list. I have obviously various different side to it. I think if you buy in too quickly, you will find out by Wall Street if there's any issues with their up-and-coming trading update. It could be a little bit at a slightly higher premium that I would have liked to buy as you know, guys. The DCF model is at 18% MOS, which I think is still short of where it could be, for me anyway, as an investor. Now, that's purely down to me. You guys, as I said, may well have a very different criteria. I think that at the moment, as it stands, we do not want to be FOMO here. I think Spotify has proved that fundamental and it's bulletproof. I think there is a few things that we're going to watch out for: the insider selling by directors or executives of the company, the fact that Apple and YouTube potentially could spend further money. I think they've got their money elsewhere at the moment in terms of the AI side, but I think Apple could be quite a danger to the market if they decide to spend a lot of money towards it. Apple, as we know, is not as AI spending as the others in terms of the Mac 7. But, I think as it stands, it's a fairly decent company, guys. I think it has a great business model. The fundamentals are good. It doesn't seem to be affected by any of their competitors. They've got quite a strong moat. The management, it seems to know what they're doing. Daniel Egg's been there from the start. Yes, he's a bit of a character, but I think he has pulled the company into the right direction. I think moving into audiobook and podcast has made a major difference of just relying on subscription and rental of music on behalf of record companies, which can be quite thin on the ground if record companies decide to change the deal or go to one of the competitors. So I think they are no longer so self-reliant on that, and the cost of it as well in terms of renting the music and the cost of paying back to the record companies nevertheless is quite high. So their margins have improved. So all in all, I think if we're going to be checking from meaning, moat, management, that ticks, fundamentals tick, DCF model is undervalued but not quite to the criteria I would suggest to wait a bit. So for me, it's on the watch list. So let me know if you guys agree with this, and if you guys are already investing in Spotify, or already investors, or have you gone up on the ride that it has gone through so far, or maybe looking at potentially buying in. My guess would be, as a strategy, to, if you are looking at buying into Spotify, even at this price now, is to only use a smaller allocation and then build that allocation as it goes on. So maybe 25% of your allocation, maybe another 25% if it falls back, and maybe another 25% so forth. So that's the kind of way I like to invest. I'd never put all of my money into one investment. But again, up to you guys how you do it. Everybody has their own way of doing it. But for me, that's the way I would approach someone like Spotify if there was potentially where we would look at in terms of as it stands now. But like I said, leave comments below. Always happy to make comments on that. Let's move on to the news for a bit in terms of where we're at the moment. I've also got a bit of news. I've bought into Uber again late yesterday. Still got Microsoft, which has fallen back further down, so we are massively in the red there. Netflix has had an absolute nightmare, so let's go to that, and then we'll move on from there. So before we end this, actually, just for you guys, actually, in terms of Spotify and the share price as well, it's always good for you guys to know where I think it's at. At the moment, really, we're looking at the one-day chart here. So we're looking at, actually, let's go for a one-week chart. So it gives us an overall picture. So as you can see, it's in between the 50 and 200-day moving average. And at this moment in time, you know, where I would probably look at more is around the 415 mark, so perhaps a bounce off the 200 moving average. Obviously, if it falls through that, then we could be looking at a pullback. But at the moment, it's come off a high, and it's in that kind of middle range of around $456. So my thought would be that if it did drop down to about 400, it would actually bring us potentially to an MOS of about 24 to 25%, which is where I would prefer it. So if you guys were to ask me for my advice, I would suggest that maybe 415 to 420, if you've, you know, is the base there. And if you want to be super safe, I would probably look at 413 to about 415 off that 200-day moving average. So that's where I would put my watch list and my alarm for Spotify. Quick look at where we're at. Oh, we've just had a sign that the pound is at 131.50. We know that in the UK at the moment it's a bit of a nightmare with politicians. We've just lost another prime minister, but that's for another day. As we spend now, the markets are at zero. We've got, obviously, you guys might be aware that there's the PCE numbers coming up tomorrow, which is obviously a big gauge that the Feds are looking for. I think the big takeaway at the moment is the Iran-US ongoing situation in terms of peace talks is ongoing. We've had fluctuating, you know, issues there, messages, I would say, and obviously the fact that the Feds may well up the actual interest rate, not cut the interest rate I was expected back in 25, at the end of 25. So that's really wobbled the markets and the bond market at the moment. So we've had a major rotation out of tech as well recently. As you can see, Microsoft Meta, that I'm actually tracking at the moment, is at an amazing price. Both now at the moment at 372 and 562 respectively, and Netflix, which I own, has had an absolute tear down. I had a little bit of a panic attack on Monday, like any retail investor do, when it flew down. I'm massively in the red on that. Again, for transparency, there's no glamour, always glamour in retail investing. I'm sure we're all going through some of the pain if you've bought or averaged out around this 90 to 80 mark, which I think a lot of people have done, looking at various different, you know, chatters. But for sure, at the moment, I am holding on to Netflix and may well even buy more. That's the way we roll. As I said, I bought into Uber yesterday. I bought about 2,800 shares, so a very small amount to start off with. I will buy more if it falls back to 69.5, 70, 69.5 to maybe 68. I made the mistake of buying in last time, and it was actually too late. I sold too early, and I could have probably made a bit more. So this time around, I am going to be patient and wait. But I do like Uber. I love the business. I've done quite a few videos on that already as it stands. So I think the market is going to be looking more at the PCE in the next 24 hours. I think it's tomorrow 1:30. So look out for that, guys, because that will move the markets either way. Apart from that, that's pretty much it. I want to thank everybody for viewing and liking my last trader update, Trader 72 on SoFi. I'm getting all mixed up now. It's getting very hot here. So thank you all for watching it and commenting on it. Please do comment more. I've had quite a few this time around. Lots of thumbs up. So great. I mean, you know, that's really, it's fantastic from my point of view in terms of helping me. Please subscribe and like. That's the most important. But like I said, I've had a bit of a week off this week, so I'm back now, and hopefully maybe we'll put out another analysis before the end of the week, depending on the hot weather, it looks like. But yeah, like I said, this is where we are at the moment. Let's wait and see. The market are at standstill, but I've got a feeling that we are going to be seeing quite a lot of volatility in the next week or so, pending on a few bits of news. and the rotation out of text. So that's actually quite interesting to see where all this is going to go. I think Micron is releasing some numbers today, so that should be interesting to see what's going to happen with the chips as well. Please also let me know any other company you'd like me to analyze. I'm very happy to do so. And from one retail investor to another, this is Trader 72, and I will speak to you for the next one, guys. Take care. All the best.